Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Today we're diving into Keppel DC REIT, Asia's first pure-play data center REIT that's been making waves with recent acquisitions. Analysts have just upgraded their rating to accumulate with a target price of $225, suggesting about 10% upside from its current price of $205. I've spent the weekend poring over their latest results, and I have to tell you, there are some really interesting developments that every Singaporean investor should know about. So whether you're thinking about adding some REITs to your portfolio or you're already holding KD REIT, this analysis is for you. Let's get started. Keppel DC REIT, trading under the ticker AJBU on the SGX, operates in the increasingly critical data center space. If you're not familiar with data centers, think of them as the physical backbone of our digital world, housing the servers and equipment that power everything from your Netflix streams to AI applications and cloud computing. KDC REIT owns quality data center assets across Asia Pacific and Europe, with a portfolio that's been growing through strategic acquisitions. Their Q1 2025 results just came out, and they're showing impressive growth across key metrics. Distribution per unit, DPU, which is what we REIT investors really care about, increased by 14.2% year over year to 2.503 Singapore cents. That's a healthy jump that aligned perfectly with analyst expectations, representing about 25% of full-year forecasts. What drove this growth? Primarily the acquisitions of Keppel DC, Singapore 7 and 8, and Tokyo Data Center 1, along with some financial engineering as they benefited from lower interest rates and loan repayments. The Analyst report I'm reviewing today has upgraded KD REIT from their previous stance to an accumulate rating with a target price of 2.25. This represents about a 10% upside from the current price of 205. The main thesis behind this upgrade centers on 3 key points: accretive acquisitions, driving strong DPU growth, improving financial metrics, and expectations for strong rental reversions in the coming quarters. Let's break down the financial performance in more detail. Gross revenue jumped 22.6% to $102.2 million compared to Q1 2024. Net property income showed an even stronger increase of 24.1%, reaching $88.1 million. The most impressive jump was in distributable income, which soared 59.4% to $61.8 million. These aren't small numbers, and they reflect management's ability to execute on their growth strategy through smart acquisitions and operational improvements. On the cost side, there's good news too. Finance costs decreased by 4.1% to $12.5 million due to lower interest rates and savings from loan repayments. This is particularly important in our current interest rate environment, where REITs with well-managed debt can outperform. KDC REIT maintained its average cost of debt at a stable 3.1%, with 68% of their debt on fixed rates, which provides good protection against potential rate hikes. The REIT's capital position looks solid too. Their gearing ratio improved to 30.2% following the completion of the divestment of Kelsterbach Data Center in March 2025. That's well below the regulatory ceiling, giving them substantial debt headroom for future acquisitions. The report does note that gearing is expected to rise to around 35% with the planned debt drawdown to finance land lease extensions for KDC Singapore 7 and 8, but that's still a comfortable level. Now let's talk about operational performance. Portfolio occupancy remained healthy at 96.5%, showing strong tenant demand. What's particularly encouraging is that KD REIT achieved rental reversions of plus 7% in Q1 2025, and they did this without any major contract renewals during the quarter. For those who aren't familiar, rental reversion refers to the change in rental rates when leases are renewed. Positive numbers mean higher rents, which is exactly what we want to see. Looking ahead, The Analyst is particularly bullish about Q2 2025, where they expect rental reversions to potentially exceed 30% as major colocation contracts in Singapore come up for renewal. About 13.6% of leases are up for renewal in FY25, most of which are Singapore colocation leases. Given Singapore's strong demand and limited supply of data center space, landlords like KDC REIT have significant pricing power. It's worth putting this performance in historical context. The REIT has been delivering consistent growth, with FY 2024 DPU up 0.7% year over year to 9.451 cents. More impressively, they achieved portfolio rental reversions of approximately 39% in FY 2024, showing their ability to capture rising market rates. So, the expected 30% plus reversions in Q2 2025 aren't a stretch. They're in line with recent performance. One area of concern that the analyst highlights is the situation with the Guangdong data centers. There's an ongoing issue with rental arrears from the master lessee, Blue Sea, which currently owes over 35 million in overdue rent. The collection of this amount could be a significant catalyst for the REIT, but there's no clear timeline or assurance on when or if this payment will be received. This situation has been dragging on for some time, and in Q1 2025, there was a loss allowance related to the GDCs that impacted DPU by 0.249 Singapore cents. This is definitely something worth monitoring. Now, let me offer my perspective on this analysis. I largely agree with the accumulate rating, but I think there are a few additional points worth considering. First, the data center sector isn't just growing. It's undergoing a transformation driven by AI adoption. Keppel is positioning itself well in this space, especially with its recent acquisitions of AI-ready hyperscale data centers in Singapore. The JLL Global Data Center Outlook projects global data center capacity to grow at 15% annually between 2023 and 27, and even this may not be enough to meet demand. KDC REIT's strategic focus on the hyperscale market aligns perfectly with these trends. Second, while the analyst notes the potential upside from collecting the 35 million in arrears from Blue Sea, I think there might be more downside risk here than acknowledged. The situation has been ongoing for over a year, and management has opted for a collaborative but firm approach rather than litigation. While this might eventually bear fruit, investors should mentally write off this amount and treat any recovery as a bonus rather than an expectation. Third, the current valuation offers a reasonable entry point. At an estimated FY25 DPU yield of 5%, KDC REIT offers a decent yield in the current market, especially considering the growth potential. However, I'd note that this yield is lower than some other S-REITs, so you're definitely paying a premium for the growth story and sector exposure. For Singaporean investors, there are some specific considerations worth mentioning. Data centers are designated as a growth sector under Singapore's economic development plans, with the government being selective about approving new developments due to power constraints. This creates a natural moat for existing players like KDC REIT, especially for their Singapore assets, which make up a significant portion of their portfolio. From a CPF or SRS investment perspective, KDC REIT is an eligible investment that could be considered as part of a diversified portfolio. The 5% estimated yield exceeds the OA interest rate of 2.5%, offering potential for both income and capital appreciation. However, remember that REITs can be more volatile than the CPF's risk-free rate, so position sizing is important. The recent Federal Reserve commentary suggesting fewer rate cuts than previously expected could impact REITs globally, including KDC REIT. However, their high proportion of fixed-rate debt, 68%, provides some insulation, and lower finance costs in Q1 suggest they're navigating the interest rate environment effectively. In terms of sector allocation, technology and digital infrastructure are increasingly important components of a forward-looking portfolio. If you believe in the continued growth of cloud computing, AI, and digital transformation, having exposure to the physical infrastructure that enables these trends makes strategic sense. KDC REIT offers one of the purest plays on this theme available on the SGX. To wrap up, Keppel DC REIT presents a compelling investment case with its recent acquisitions, driving strong DPU growth, healthy portfolio occupancy, and expectations for significant rental reversions in the upcoming quarters. The current price of $2.05 offers about 10% upside to the analyst target price of $2.25, with an estimated 5% yield for FY25. The key catalysts to watch include the upcoming contract renewals in Q2 2025 that could drive strong rental reversions, any resolution of the Guangdong data center's rental arrears situation, and future acquisition opportunities given their improved balance sheet with 30.2% gearing. The main risks to monitor are any deterioration in the Guangdong situation, potential weakness in the broader REIT sector if interest rates remain higher for longer, and execution risks associated with integrating recent acquisitions. My personal take? If you're looking for exposure to the digital infrastructure sector with income potential, KD REIT deserves a place on your watch list. The recent pullback offers a reasonable entry point for long-term investors who can tolerate some volatility along the way. As always, though, maintain proper position sizing and consider how it fits within your overall portfolio strategy. That's all for today, friends. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into Singapore stocks and REITs. I'd love to hear your thoughts on KD REIT in the comments below. Until next time, this is Iggy from the Investing Iguana, helping you grow your wealth one video at a time.